Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class. Remember, class is still in session because the learning never stops. And so today is going to actually be video 2 in a 4-part video series where we talk about different types of loss limitations. And so today we're going to talk about the loss limitation of basis loss limitations. And so just to kind of bring this back up, if you see here, we have this is the graphic that we introduced in the other video. And by the way, if you haven't taken a look at video 1, I recommend that you do that. It's going to basically be the loss limitations overview, where we kind of talked about all this sort of stuff in a broad general sense. And so part of all that ended up happening is we talked about the different types of loss limitations that can exist, and some of the overview of some of the loss limitations as a whole. And so what we're going to end up doing today is we're going to be focusing on the topic of basis limitations. And so the next slide that I want to show you here is, what is basis? A lot of times when we're talking with our clients, and also, as you guys know, I'm a professor at a local university, and I talk to my students about what basis is. The phrase that I tend to use with these people, with all people, I guess, would be basis given is basis received. And so if you think about it, when you actually go ahead and you start an organization, and as we talked about in the first video, we're going to be using a partnership as kind of our key discussion to have this. But this also exists when you talk about other types of organizations, S corporations, C corporations, and things of that nature. There's a basis that ends up getting calculated. Now, in the IRS codes and regulations, they actually talk about how this goes, and the overall thing that I like to say is basis given is basis received. So when you form that company, and say, for example, you've got you and a buddy, and you're going to go ahead and you're going to form a partnership to go purchase a piece of land, and both of you have $50,000 cash, but nobody has the $400,000 that's necessary to purchase the land. And so you contribute $50,000, your friend contributes their $50,000, and then so together, both of you have $100,000. Well, in the partnership's basis calculations, and this time we're talking about what we refer to as outside basis. This is basis that is to the partner. The $50,000 that each of you contributed is going to be basis to you in the sum of $50,000. And that's how cash works. Cash is one of the few things that's out there that the fair market value of cash is what cash is. And so cash is probably the one thing that the IRS says basis always equals its fair market value, and that's just because of the fact that you contribute $50,000 of cash, that value doesn't change from a relativistic standpoint. Now we can go into huge amounts of theory talking about whether with inflation, deflation, all that sort of stuff from economics, but quite frankly, the IRS is not concerned about what an economical view of cash is, as opposed to you put in $50,000 of cash, you get $50,000 of basis. Now, property is a little different. Now, when we say property, we can be talking about any kind of property. We're talking land, buildings, cars, trucks, furniture. Very good example. You see back here we have the computer monitors. If I bought those computer monitors on my own and then contributed them to the basis of the partnership, what would happen is that the amount that I actually paid for the computer monitors, which is basis, would be considered basis in the partnership as a whole. And so if I buy the computer monitors and then say 2 or 3 weeks later I contribute them to the partnership, the basis in my basis in the partnership would be increased by how much I paid for those monitors. Now, basis can basically be modified by a variety of things, and I'm not talking about the rolling basis down below, but I'm talking about the property basis. If you've had any depreciation, that actually decreases your basis. If you've had any improvements made to the property, that can increase basis. And so basis is not simply cost. There are actually multiple variations that get thrown into when you're actually trying to calculate how much the basis is of what you put in. And this is why, if you're going to form first of all, you're going to form a partnership and you're not talking to a CPA, EA, or a tax attorney, I think you're ludicrous. You should be talking to one of those two, a CPA, EA, or tax attorney. If you have any questions about that, we do have a video about CPA, EAs, and tax attorneys and why they're important. But I would say in the terms of the partnership, you really want to make sure that you're talking to CPAs, EAs, or tax attorneys, because they're going to be able to help you figure out some of this stuff when you're talking about things other than cash that you're contributing. And there's also going to be some times where we're going to say, look, thanks for choosing us to do your tax returns. However, there's also some legal stuff you're going to need to do, so we're going to probably push you over to an attorney that can help you with some of that stuff. Now, some of you might say, well, Kevin, if I'm going to have to use an attorney anyways, why don't I just use a tax attorney for this? That's almost like going to the dealer to fix your car for everything that you do. You can usually get things done, repaired on your car for less of a cost. With certain things. Now, there's certain things that you have to get fixed. Very good example. I have one of those Toyota Camrys that has the navigator, the screen navigation system, and I cracked the screen when I got into a small little fender bender that I got involved with. What happens is that to replace that, it's almost better to go to the dealer to get that replaced, because you want to make sure that they're using the right parts. But for example, when I went to go get the fender repaired, I wasn't going to take it to the dealer to do it, because the dealer was going to charge me 2 or 3 times as much. That's kind of how the tax attorney would work with this. Yeah, they could do some of the stuff that you need to legally in order to help this out, but it might be a little bit of overkill. Now, that said, so once you've actually contributed all of your property to the business, so you put in your $50,000, your friend puts in $50,000, the basis then become, we sometimes refer to this as rolling basis. Some firms do that, most don't. I've heard rolling basis be used by a number of firms, and I tend to use it that way, and I say, your rolling basis, which basically is your basis as you're going forward. And the basis is going to be increased by contribution. So, for example, you contribute each of you contributes $100,000 total. $50,000 total for a total of $100,000. You buy a piece of property for $400,000, so you borrow $300,000 to do that. But maybe you decide then you're going to do some improvements on it, and you need to contribute additional cash in order to be able to get that. That additional contribution would increase your basis in the partnership. It's also going to be increased by income. So as you have additional income from this partnership, that's also going to increase your basis. Now, as income increases your basis, losses will decrease your basis. And also, if you decide to take any distributions out, so say for example you buy the land, you improve the property, it now becomes $1 million property. You have $40,000 of cash in the company, and you go to the partner and say, hey, I need to take out $10,000 to pay some taxes that we have that's due. What'll end up happening is that will decrease. You'll take $10,000 out of the company. It'll reduce your basis by that $10,000, and so that's kind of how that happens in a nutshell. Now we talk about basis, and if you take a look at this, the previous slide. All of this is, basically capital-based basis. So, for example, it's cash, property, things of that nature. Partnerships have a very unique attribute where they can actually receive what's called debt basis. Now, all you S corporation guys out there, well, we can get debt basis from S corps too. Yeah, you can, but it's a little bit more difficult to do. And I would be happy to talk about that in another video where we talk about debt basis and S corps. But in partnerships, all of the loans of the partnership, regardless of whether they're secured, unsecured, guaranteed by a partner, unguaranteed by a partner, as long as the partnership itself is responsible for that loan in some way, shape, or form, you get debt basis as a result of that. Now, kind of taking it out, if you actually take a loan out, so for example, in our example, $50,000 per partner, you're going to go out and buy a $400,000 piece of land. In order to do that, you go out and you take a loan. That is actually going to be, the way it kind of works, and this is it's a synonym, it's synonymous with you actually contributing cash. Because the way they're thinking about it is you get it from the bank, you contribute it to the partnership, and so it's going to be seen as a cash contribution. Now, as that debt gets paid off over time, that's going to be seen similar to a cash distribution. So as you pay off that loan over time, you're going to notice that you're going to have a reduction in debt basis as a result of this. This can cause some issues. We've had some times where we've been filling out tax returns for clients, and we notice that the debt basis goes from $50,000 to zero because they decided to pay off their loans. Well, and we'll talk a little bit about this when we get to the loss limitations portions of this, but some of those losses were being trapped because of, the basis was able to be used, so they were using some of their debt basis to be able to take their loans, and as a result of which, you pay off the loans. Well, now all of a sudden it's going to be seen like you've taken a cash distribution in excess of basis, which of course is a taxable event. So we have to be very cautious and careful about this. Now, according to Code Section 752, which deals with different types of debt instruments related to partnerships, there's 3 different types of debt. And you have your non-recourse debt, your recourse debt, and your qualified non-recourse mortgage financing. Now, non-recourse debt is basically, it's debt that the partnership owes to somebody else, but if for some reason the partnership can't pay that debt, nobody else is responsible for that debt. It's just the partnership itself. Now, banks traditionally will not lend to people on a non-recourse basis unless there's incredibly good credit, or they have an exorbitant amount of experience in dealing with the partnership. A very common non-recourse debt that I tend to see, is like accounts payable. So, for example, I have lights in my business. I have I have electricity that gets done, and I also have internet and all that sort of stuff. If for some reason the business went belly up tomorrow and we had some debts that weren't able to be paid off, and this was a partnership, more likely than not, the power company is not going to be able to go after the partner themselves in order to be able to get that back. And that's general. Now that also depends upon what the laws of your state are, but generally speaking, that's the case. I was working with a client who the business did go belly up, and they had a $5,000 phone bill that the phone company never was able to recover, and as a result of which, it just was gone. So that's kind of the non-recourse liabilities that we're kind of talking about. Recourse liabilities. So this is when you go to a bank and you take out a loan, and the bank goes, we really don't know you. We know you, partner. We don't know you, partnership, but we know you, partner, because of your credit score. You have the 6 C's, as they like to call it, where credit, character, and all that sort of stuff happens. And so what happens with the recourse is the bank says, look, because you have all the 6 C's all lined up, we're going to go ahead and we're going to loan you the money, but partner, we want you to be personally responsible for this. And if you're willing to sign on the dotted line that you're going to be personally responsible for it, we're going to let you do that. And so that's an example of of recourse debt. So qualified non-recourse mortgage financing, what that kind of debt is that, so for example, what will happen is that periodically people, what they'll do is that you're going to go out and you're going to buy land. So what happens is you go to the bank, you borrow money in order to buy the land. Or buy the building. And so in our example where I said, look, I'm going to put $50,000 in, my friend's going to put in $50,000 in, and then the two of us are going to go to the bank together, we borrow another $300,000 to buy this land and start building a building that's going to go onto it. What's going to happen is that the bank's going to come back and say, hey, look, for this mortgage financing that we're going to do for you, we're going to secure the land in order to be able to do it. And Congress put in this this exemption for multiple reasons. Not the least of which is to encourage land development and building development. They want to encourage people to go out and buy land, buy buildings, because that spurs economic activity. But I think also from a tax standpoint, from a theoretical standpoint, this kind of makes some sense also. The thought process is, with the recourse financing, you're agreeing to accept a risk. Okay, and so they're going to give you a special type of status that's going to take place as a result of of this recourse financing. Now, when it comes to the qualified non-recourse mortgage financing, because there's an opportunity that the land could be taken away if the debt can't be paid. I think that is a significant risk that people are accepting, because, I mean, if you think about it, a piece of land, in this case with a partnership, if we build a building and we try to rent that building out, we lose the building, we lose our income opportunities. And so I think that there is a theoretical foundation for why they've made this exception. And then, of course, a very practical one where they've kind of said, hey, look, as a nation, it's better for us to be able to go out there and to be able to encourage people to do good things by borrowing money. So now here's the other thing. Basis in and of itself is, and this is on the debt basis slide, but to be honest, this is really, it's not, it kind of relates to the whole thing. Basis in and of itself is actually not calculated on a specific tax form. You'll notice when we do the risk limitations and we do the passive limitations, those actually fall onto various tax forms. But basis actually, in and of itself, is usually calculated by the partner directly. So, and this actually comes into a little bit of an issue that we've seen in the past, where we have clients who say, hey, look, I went ahead and I got my partnership tax return done. For the partnership's closing down. We need to calculate what my loss is. Well, there's this kind of disconnect that ends up happening. There's a belief by many clients that the partnership tax return preparation service should be calculating the basis for them, and traditionally that's not what ends up happening. There's an understanding in the CPA industry that usually it's the partner's CPA that does all that calculation, because what ends up happening is there's a lot of things that can go into that calculation of that partnership basis, and so as a result of which, usually what will end up happening is that the partner's CPA will actually do it. Now, oftentimes the partner's CPA is the same as the partnership CPA, and so that's usually not hard to do. Where I've had some problems with it, I have a couple clients where they do a significant amount of, they're significant owners in partnerships, but for some reason they choose not to work with the CPA that the partnership tax return gets done with, could be cost, could be, a whole host of reasons. And so this will not actually be done there. And I'm not going to lie to you, I think that a good number of CPAs don't actually calculate this basis. Oftentimes, what will happen is that they'll start looking at how much basis you have in your partnership as a partner when the time comes. So, for example, if I've had a K1, I have a client who's got a K1 and they've been making income over and over and over and over and over again for years and years and years, what ends up happening is if there's income, I mean, there is no basis limitation to worry about, so why calculate it? That's additional work the client's not going to pay for, and the client will kind of come back to us and say, well, why would you even waste my time with that? So normally what ends up happening is that if there's a significant loss that takes place, or worse yet, if there is the partnership goes through dissolution, and then we kind of go back to them and say, yeah, we need 20 years worth of tax returns in order to figure out what your basis is. Well, sometimes the client won't have that. And so usually what will end up happening is that we have to reconstruct as much as we can. Usually involves several calls to the IRS, usually involves several calls to the client's previous CPA, some of which are willing to help, some of them are not. Here at Beta Solutions, I'm willing to help anybody who has taken over one of my clients, and I'll just be like, hey, look, I'll hand you what you need in order to be able to get that accomplished, because we're not going to be bad people. That's just kind of the way that we work. Again, it's calculated at the partner level. It's not calculated at the partnership level, because there could be additional things that are taking place outside of the partnership tax return. So the application of the loss is in excess of basis. So, for example, we borrow this money, and I have $50,000 of basis. We haven't talked about how the debt actually gets allocated. Well, I think we'll talk about that in a little bit of a later slide. And so what happens is, as we're kind of going through, yeah, we'll talk about that a little bit late in a later slide. But basically, what happens is, when we're taking a look at, you have losses in excess of basis. So I put in $50,000, $150,000 comes to me through the debt basis, and so I have a total of $200,000 what will end up happening is if I had losses in excess of $200,000 in the first year, not likely to happen in this case, but let's pretend for 5 seconds it does, and I have $250,000 of losses. $50,000 or $200,000 are going to be able to be passed through debt basis. Again, getting back to this, the leaky bucket. So it goes into this leaky bucket, and then it falls down into the at-risk limitation. Now, again, we won't talk about at-risk limitations until a little bit later on, but it goes past that basis limitation. The $200,000 does, but the $50,000 doesn't. That gets trapped up here into what we call, basis losses in excess of basis. Now, what happens? They're suspended, and it's carried forward going forward until one of two things happens: until you have adequate income or gains to cover the carryover losses. Another thing, and I didn't put this on the slide, a contribution happens. So you go ahead and you make a contribution to the partnership in order to cover some of those losses. You can have that basis. That you can have that loss in excess of basis, because it won't be in excess of basis because you made a contribution in order to be able to do it. And so that is actually a method that we've used in the past in order to help people get a loss. Hey, just make a contribution to the partnership. They probably need it anyways in order to get this other stuff done. And then they can kind of work out all the details of what happens. And some partnerships that I've worked with in the past, what will end up happening is that they'll have it written into their operating agreement, whether they sit there and they say, hey, look, if we have losses, totaling of X number of thousands of dollars, you're going to be required to make a capital contribution in terms of X, and they could do that. But generally speaking, if that ends up happening, that's going to be determined based on the needs at the time. This, if you take a look at a K1, basically all of your activities reporting to the partner is going to be done through a schedule called Schedule K1. I don't have an example of it up here, but I did take a portion of that Schedule K1, which is box K. Nope, just pure randomness. It's no pun intended. But it's the partner share of the liabilities is going to basically be broken out here. And so what'll happen is, for us in my example, we just started this year. So in the beginning of the year, we had nothing. And then we go out and then we borrow money in order to be able to fill out the partnership, and then to buy the land and start building the building, and that's going to allow us to have an ending balance in our qualified non-recourse financing, and that's generally what's going to end up happening. That's going to allow us to keep that track. This box is actually very important. I've had a number of partnership tax returns where this number is not done correctly. And as a result of which, I've had times where I've gone to the client and I said, yeah, I'd be happy to help you out with this, but we're kind of trapped because this, and oftentimes what happens is when they fill out the partnership tax return, they just didn't put a lot of focus in on this because, they're like, oh, well, there's some non-recourse financing. Well, if you had non-recourse financing, why didn't you let us know? Because, for a variety of reasons. And so usually that we have to go back to the partner and say, you need to go back to their CPA and figure out what needs to happen. And so, and sometimes they have to do an amended partnership tax return in order to get things to do right. So when we're talking about the allocation of the loans to the partners, this is actually, it's pretty simplistic actually. What'll end up happening is they'll have, so you'll have, general non-recourse debt, which is generally allocated by income and losses. That's according to Code Section 752, and then of course this is an IRS regulation, 752-1, subsection A, paragraph 2. Basically, I'll say, hey, look, you're going to do this by income and losses. And so if you take a look at a K1, there's going to be three types of divisions of various things. And one of them is going to be profits, one's losses, and the other one is capital. And so what ends up happening is profit and losses usually are done through agreement. So for example, the two of us put in $50,000 together. We say, hey, look, I want 50-50 split on the profits. That's usually what ends up happening, and that's generally, usually it'll be even, but there's sometimes where people basically say, look, I don't have any money, but I'm going to form a partnership with you. You put up all the money, I'll do all the work, and as a result of which we'll split 50-50. What will end up happening is profits and losses are 50-50, and then the capital is going to be 100% to the other person because they put up all the money. So that's the kind of, so there could be some differences that could exist. And again, generally it's allocated by income and losses. It can get complicated if they're secured using property of the partnership. And I'm not going to go too far into this because this video is going too long already as it is, and so I won't get much into it, but that's kind of what they were saying. Recourse debt is generally allocated to the partner who bears economic risk of loss, and that's actually word for word from the IRS regulation 752 TAC 1 subsection A paragraph 1, which basically says, hey, look, so if we go out and we're going to borrow $100,000 for the partnership, and this time I want all of it to come to me, I'm going to bear the economic risk of loss because maybe I have more money than my partner does. So I say, okay, we're going to borrow $100,000. We're going to tell the bank I'll take the hit if for some reason something happens. Recourse debt, what's going to happen is it's going to be allocated 100% to me. Now, if we did recourse allocation and it was 50-50 to each one of us, it's 50-50 to each one of us. Has nothing to do with income and losses. It's all based on who bears the economic risk of loss. And that's going to be a very important thing. This means, and I'm sorry, I'm going to actually disappear my picture here real quick so you can see this fully. But it basically means that it has to be examined on a debt individually. So in other words, each individual debt item that's going to be creating this basis has to be individually examined, because you have to make sure that it gets, because for example, I may bear the economic risk of loss on one loan, my partner may bear the economic risk of loss on another loan, and if that ends up being the case, that partner then gets 100% of the allocation for that, because he or she has gone ahead and bore that economic risk of loss. Therefore, they get it. Qualified non-recourse mortgage debt is going to be done based off of like I said, it's going to be based off of the non-recourse debt rules, and so we have to follow that at that point. Again, this is kind of how this happens. So if you get past the basis limitations on the bucket here, the leaky bucket is going to leak out and it's going to go to the at-risk limitations. Very useful, very helpful, and so that ends up being helpful with that. And then, of course, next you're going to have to do with the risk limitations, which, of course, is our next video. And then it's also going to be the passive limitations, which will be in the video following that. And so that ends up being good for that nature. So that's all I got to say about that. I want to say thank you very much for attending this video. I know it's a little long, and I know some of these videos are going to be long, but it's going to be chock full of information again. I want to thank you very much for attending this class. Remember, my name is Kevin Matthews. I am the tax professor. Class is still in session because learning never stops. I want to invite you to come back for video number 3 and 4, which of course will be videotaping and broadcasting at a later date. If you have any questions, feel free to reach out to us. Something else before I go. Thank you very much for watching this video. If you liked the video, go ahead and hit the like button. And then if you really like this video and you like the entire video series, go ahead and hit subscribe, and I'll be happy to let you guys know when we actually have more videos coming out.